from moneyvineyard.com, growing your money through value investing. This is kind of an update on the last blog post where I told you it was called How to Value the Stock Market. And it basically explained how to go through and determine, what's a better value, either stocks or bonds. And this graph here actually kind of shows that strategy in action. This yellowish or lighter line is that strategy, which I'll explain here in a second. And then this darker reddish line is the S&P 500 for the past 10 years. This is their return. So basically, here is the strategy. And if you don't know what I'm talking about, you can go through and read the last blog post again, How to Value the Stock Market, and it kind of tells you what I'm talking about here. So this here is that yellowish strategy from that previous graph that we just saw, and what this is your asset allocation each year. So in 2000, we had 75% bonds and 25% stock. So I'm assuming that if the bonds have the 2 times advantage, then you're going to put most of your money into the bonds. So here, bonds had the 2-time advantage, so we had most of our money in bonds. Same goes here. And then the other part of this strategy is that if there ever is an advantage to either stocks or bonds, you hold that same asset allocation for 2 years. So I'm not sure if that makes much sense, but so here in 2001, bonds had that advantage. In 2002, they still had that advantage, but they didn't have that 2 times advantage that I'm talking about. But because they had it here, I'm going to make that asset allocation and hold it for 2 years, so until 2003. Same thing up here. 2009. This would be like January 1st, 2009. Stocks had that 2 times advantage, so I'm going to hold that 75% stock, 25% bond portfolio. I'm going to keep that same asset allocation until January 1st, 2011. So just it's kind of an arbitrary rule, but holding it for 2 years seems to make a lot of sense. It gives it enough time for the value to work itself out. So if there is a 2 times advantage, you go 75% to whatever has that advantage, and you stay 25% in the one that doesn't have the advantage, and you hold that allocation for 2 years. So I'm sorry if that doesn't make any sense. And then here's your returns per year using that strategy versus the S&P. As you can tell, it's definitely the down years for the S&P 500 where this Ben Graham value strategy definitely outperforms, because in these years, it lags behind the returns of the S&P 500 just because that's kind of the way the strategy is set up. Yeah, so that should pretty much do it. Thanks.